Beyond Meat is currently trading at 65 cents, surging an astonishing 24.15% in intraday trading. Now, seeing a 24% green candle like that, the immediate expectation is that some truly groundbreaking news must have hit the wires. A surprise buyout offer, a massive new partnership, perhaps a regulatory miracle that bans conventional meat. But the reality, when we look at the volume, the context, and the price point, is that this looks less like a fundamental revival and more like a desperate technical gasp for air. This surge is happening at a price point, 65 cents, that signifies a company on the absolute brink, fighting off a potential delisting from the NASDAQ. This isn't a celebration, it's a volatility warning. Many traders on platforms like Robinhood or SoFi Invest might see this percentage pop and attempt to jump on. But the real story here isn't the 24% gain, it's the 99% collapse that preceded it. For years, the common belief surrounding Beyond Meat was one of inevitable, unstoppable adoption. This was supposed to be the Tesla stock of the food world. Investors piled into this name, believing that plant-based protein wasn't just a niche, but the logical successor to the entire traditional meat industry. We all bought into the narrative. It was cleaner, greener, healthier, and the future. The stock's IPO was one of the most successful of its decade, and every Fidelity or Schwab Intelligent Portfolios account seemed to want exposure. The expectation was that penetration into giants like McDonald's and Yum brands would solidify its dominance, making it a cornerstone holding just like Apple stock or Nvidia stock. The reality that the financials have revealed, however, is brutal. The adoption stalled hard. The major fast food partnerships like the McPlant burger were largely discontinued or limited to minor, unsuccessful tests. Consumers, squeezed by persistent inflation, looked at the high price point of Beyond products compared to traditional, cheaper proteins and simply walked away. The competition didn't just come from its rival Impossible Foods, it came from the private label lines at Kroger, Safeway, and from the legacy giants like Tyson launching their own flexitarian products. The market became saturated, the research and development costs remained astronomical, and the cash burn accelerated to terrifying levels. Let's really analyze today's 24% move. The volume is high, but look where it's coming from. This isn't the slow, steady accumulation you see when major funds using Fidelity Wealth Management or sophisticated interactive brokers terminals build a long-term position. This is the frantic, high-velocity, algorithm-driven trading characteristic of retail momentum chasers and, most importantly, a massive short squeeze. The stock recently hit all-time lows, making it a prime target. When a stock gets this low, well under $1, it ceases to be an investment in the traditional sense. It's no longer a holding you buy through Fidelity mutual funds, it becomes a speculative vehicle, a lottery ticket. The short interest in Beyond Meat has been consistently high for a very good reason. The expectation, the story of changing the world, was completely disconnected from the reality, the catastrophic cash burn. Traders using the sophisticated tools on interactive brokers trading platforms have been betting against this company's survival for months. Today's 24% spike is almost certainly a cascade of those shorts being forced to cover. A small bit of buying volume forces shorts to buy back shares to close their position, which creates more buying, forcing more shorts to cover. It's a feedback loop that has absolutely nothing to do with the company's long-term health. The macroeconomic environment has been a relentless headwind. High inflation directly attacks Beyond's core value proposition. When a conventional burger patty is $3 per pound and a Beyond patty is $6, the household budget wins every time. This isn't a failure of marketing, it's a failure of unit economics in a stressed economy. Furthermore, interest rates staying higher for longer crushes companies that are cash burn intensive. Beyond Meat is the poster child for this. They need constant capital to fund R&D, manufacturing, and marketing, and that capital is no longer cheap or free. Looking at institutional activity from 13F filings, the trend has been one of overwhelming distribution, that is, selling. The broad-based Fidelity ETFs that track large indexes have seen their BYND positions evaporate as the company's market cap collapsed. The reality is that institutional support is gone. They aren't interested in funding a high-concept story anymore. They need to see a path to profitability, and Beyond hasn't been able to show one. This company is now deep in delisting territory, fighting to stay above the $1 minimum bid requirement. A reverse stock split seems not just likely, but inevitable, which is often a signal of deep financial distress. Now, for those who are new to this name, perhaps drawn in by today's massive percentage gain on the Robinhood app or Fidelity mobile app, what is Beyond Meat? This company was founded on the ambitious idea of creating plant-based substitutes for meat: burgers, sausages, ground beef, and even chicken, using a proprietary blend of pea protein, canola oil, coconut oil, and other ingredients. Their business model relies on two main channels: retail, selling their packaged products in grocery stores, and food service, selling to restaurants from small chains to, previously, large-scale tests with major fast food players. The IPO in 2019 was astonishing. It priced at $25 and rocketed to over $230 within months. Everyone doing self-investing or using online investment services wanted a piece. But that peak was driven by pure, unadulterated hype, not sustainable financials. Since that peak, the story has been one of sequential revenue declines. Their recent earnings reports haven't just missed analyst expectations, they've shown a contracting business. Worse, gross margins went negative. That means it was costing them more money to produce and ship the product than they were selling it for. This is the core of the crisis. When you compare this to the relentless margin efficiency of a company like Apple stock, you realize Beyond Meat is not just in a different league, it's playing an entirely different and failing sport. This isn't the kind of stock a prudent SoFi robo-advisor would ever select for a balanced, intelligent portfolio. This brings me to an important question, and I want to see your answers. Comment below. Do you believe plant-based meat is just a stalled fad, or is this a temporary economic setback before it truly takes over the industry? Let me know what you think. So, what is the future outlook? What's the bull case? The expectation held by the few remaining bulls is that a new product, the Beyond 4 platform, will finally crack the code on taste and health, that a new aggressive cost-cutting plan will stabilize the cash burn, or that a larger CPG, like a Kraft Heinz or a Unilever, will acquire them for pennies on the dollar just for the brand recognition. The reality is that time is running out. The balance sheet is weak. A positive catalyst would need to be monumental. The Beyond 4 product line is a significant update, aiming to simplify the ingredient list and improve the health profile. But will it be enough to overcome the brand damage and consumer apathy that has set in? It's a tough sell. The acquisition argument is also weak. Why would a CPG giant buy a high-burn, negative margin operation when they can just build their own private label version for a fraction of the cost, using their existing massive distribution network? The risks are stark and immediate. First, the delisting notice from the NASDAQ. It's a procedural certainty if the price stays below $1 for 30 consecutive days. The company will be forced into a reverse stock split to regain compliance. For those unfamiliar, that's when they take, say, 20 of your shares at 65 cents and merge them into one new share, artificially raising the price to $13. This sounds neutral, but historically it's a profoundly bearish signal. It allows institutional shorts using platforms like Interactive Brokers to reload their short positions at a more stable price. It also often wipes out Robinhood fractional shares holders. The second risk is cash insolvency. The company must stop the cash burn or it will simply run out of money in the next 18 to 24 months. This isn't a long-term investment consideration, it's a near-term survival question. This is why standard investment help or guides to online investing don't apply here. The kind of analysis you'd use for your Fidelity IRAs or an individual brokerage account holding blue chips is useless. For someone looking at this on a SoFi trading platform or seeing the buzz on SoFi investing forums, this must be understood. This 0.65 stock is